To Daily Conversation. This is Mr. K.
This is Eric.
Yeah, today is the 22nd of April 2021, and the time now is 6:17 a.m. Well, today our topic is what is the best financial advice you ever received for getting wealthy? So before we get started, please click the like button and subscribe to our YouTube channel. All right, so here we go. Yep. Okay. So, for the topic today, talk about getting wealthy.
Mm.
Yep. For me, I think the best advice that I get uh, is from you uh, to start investment. Yep. But yeah, if you talk about wealthy, and actually it is quite difficult for me. Yep, because we
No,
know.
no, wealthy is not difficult to you. Don't say that. Touch wood.
Yeah, right. Okay, I know that we have two aspects we need to uh, work on it. And the first part is our income level. And
Mm.
then by increasing our income level, we will have more uh, money which we can use. Uh, I mean, we have more savings. Yeah, after deducting all the expenses every month, how much we have. And the more savings we have, and then the more we can invest. And this is very crucial uh,
Mm.
in getting rich by investment. Yeah, the
Mm.
amount that you invest every month
Mm.
cannot be too low. Yep. So yeah. So actually that's it. And when thinking about this topic, actually I have one um, question in my mind. Yeah, and
Mm.
then yeah, I think this is maybe some misunderstanding in my concept. I suddenly um, uh, found that if we invest in stock, uh, we actually don't get compound interest, right?
Oh, why?
Because the part of dividend is so little.
Mm.
Because the concept of compound interest is that we invest money and then the interest that we get can generate more interest, right?
Yeah, you can say that. Mm.
Yeah, so for stock, I couldn't understand if you say they are compound interest, other than the effect from dividend, but dividend is just a very small amount.
Yeah. Normally we say investing in stock. When
Yeah,
we talk about the compounding interest, and we are not somehow like looking at investment that will generate you 15% return every year. We are not looking
okay.
for that. We actually we usually aim for higher rate. For example, we think this. For example, you are doing value investing,
Mm,
okay, and you think the company is undervalued 15%. Will you invest? Maybe yes, maybe no, because you don't know how much time it need to take
yeah.
to back to the fair value. Maybe 1 year, maybe 2 years. So if 1 year or within 1 year, so that means your target will be hit. Your target will
Mm,
be hit. So if
yeah.
2 years, that means your target is underrated.
Mm,
Yeah.
yes.
So that means you are trying to find the uh the investment that can generate 15%. Yeah, 15%. To grow your fund 50% every year.
Yeah.
But this is in average. So that means you buy a stock. You buy a stock that can give you 100% returns.
Yeah.
And then you invest, and then so in long term maybe investing in that stock can give you 15% annualized return, which is
Okay.
means of 15% compound interest. Or maybe you do some you are a growth investor. Okay, you are doing the growth investing, so you're looking for trend, and then you invest in those company which have some certainty that can grow to the biggest company, or grow to the best company, the most valuable company in the world.
Yeah.
For example, like Tesla, Apple, Amazon. Yeah, I mean, in few years, few years ago, like Apple, Amazon, few years ago.
Yeah.
And you aim for that, and you also think you investing in this stock will generate you a very, very high return. Yeah.
Yep.
Yeah. So that when we talking about the compound interest rate, we are not talking about a particular company. We actually are talking about you, the individual. Yeah. What is your ability? Can you generate 15% annualized returns every year? Or can you generate 20%? Or can you generate 30%? Yeah. For example, Warren Buffett, for his investing experience,
Yeah.
and he can generate, if I'm not wrong, it's like 24 or 25% annualized return. So this is also the compound interest rate. Yeah. So that means, yeah, but he can keep this for more than like 50 years. This is crazy. Yeah, 50
Okay.
years. 50 years compound interest, 24%. But if you look at the Berkshire share price in these few years,
Yeah.
it didn't rise so much. Maybe it rise like maybe just 50% or maybe 30%. I didn't check. Maybe 30% or 50% in these 5 years, or some figure around there. Yeah. So how can you say Warren Buffett have 25% compound interest rate? Yeah, because if you look at these few years growth, yeah, it's not even hit that. Yeah, it's not even hit that 100.
Okay.
But why Warren Buffett still can maintain that? Because in the first few years, or maybe in the middle of his investing years, yeah, he earned a lot. Yeah, maybe at that time his compound interest rate is not only 24%, it's maybe 50% or maybe 100%. Yeah, but now because the fund is getting bigger and bigger, yeah, so you cannot grow the same amount of fund with that same rate. Yeah, with that same high rate, so that the rate will be reduced. Okay, the rate will be reduced. Yeah. So that but you analyze from year 0, you have 10K, and then at like year 20 or year 30 or year 50, yeah, your amount is like 1 million. So you calculate your compound interest rate. Yeah, there's a formula. Yeah.
Oh, I see.
Yeah, so compound interest rate is actually, when we talk about compound interest rate, is actually talking about your ability and talking about whether, for example, if we talk about like 8% or 10%, we are talking about, yeah, whether a normal people can very easily earn this compound interest rate. For example, you investing in the SP 500 or Nasdaq. Yeah, it may give you like 10% or 8% or sometimes 50%. Yeah, and we have done one statistic in the gold investing conversation.
Yeah.
Yeah, and I always forget the figure. Yeah, and you can refer back. If I'm not wrong, like 10 years time, or in 15 years time, or in 5 years times, if you invest in SP 500, you can get like 15% annualized return.
Okay.
Yeah, so that is the compound interest we refer to.
Oh, okay. Yeah, I think I am bad at this concept. Let's say if we invest in a stock for, let's say, make it simple, 100. And then let's say after a year, this stock become this stock increase its value to 200. So for this, if we calculate the return,
Looking for your fund, looking for your network, looking for your fund value, because you may have dividend, you may have bonus share, so the price can cut in half. Yeah, so looking for your total fund value, not looking at the share price.
Oh, okay. Then assume that the stock, just now what's the words you use? The fund value?
Yeah, the
Okay,
total
so
investment fund.
okay, so if we invest 100, and then after a year the fund value become 200.
Okay.
Yeah, so in that case, the 100% of return is only simple interest, right? And then if we calculate the annualized return, it will less than 100%. Is it something like that?
No, in 1 year time, simple interest always equal to compound interest rate.
Okay.
Right.
Yeah.
Unless you are calculating like the quarterly compound interest rate or monthly compound interest rate. Yeah, because 1 is always equal to 1. There is no compound. Yeah, if the basement is 1, so that means whatever divided to the basement is also the same result. This is
Yeah.
a mathematical concept.
How about 2 years?
Yeah, 2 years the compound interest will have the different will show you a different amount. For example, yeah, now you have 100 and 100% gain, 100% profit. So next year 0 you have 100, year 1 your fund grow to 200.
Yeah.
Right.
Yeah.
Then if you want to maintain the compound interest 100%, so in year 2 how much money you need to grow to is 400. Yeah. So but for simple interest rate, how much you earn for this for these 2 years is 400%. Is 300%.
300%. Okay. Yeah, because 100 is our capital, right?
Yes.
Then yeah, then there is no compound interest, right? For here it's just simple interest.
Okay. The compound interest calculation is actually based on uh the present the compound interest rate. If you want to calculate a year by year, the interest rate is actually using okay. The calculation the calculation difference between simple interest rate and compound interest rate is actually the basement. For simple interest rate, you're always using the year zero amount.
Yeah.
Okay, but
Right.
compound interest rate, if you calculate, uh, it depends. Yeah, it depends. It depends you. It depends you which year you want to calculate, or you want to calculate a total years, maybe total 10 years, the compound interest rate from year 1 grow to year 10. So let assume you only calculate 1 year. Okay,
Yeah.
you only calculate 1 year, and you want to calculate your compound interest rate from year 1 to year 2. Okay, yeah, bear in mind from year 1 to year 2.
Yeah.
So your compound interest rate is actually the basement of the basement is using the year 1 amount. Well, at the same time, if you calculate simple interest rate, is using the year 0.
Yeah.
Yeah, if you don't understand, you can Google the compound interest rate formula. Yeah, I think by playing around the figure is more than 1,000 word. Yeah. So if you try to search the simple interest rate formula and also the compound interest rate formula, you can see the difference.
Okay. Okay, yeah, I understand that the simple interest always use the year zero figure and then just multiply by the percentage and that's it. And yeah, but if we invest in the stock, let's say the fund value increase, but at the end of the day, the money that we invest is still the amount in year zero, right?
Can you repeat again?
Okay, let's say in year zero we invest 100, and then every year we only invest 100. So year zero is 100, and year one is another additional 100, and if this go to year 10, and then the 100 that we invest in year zero, uh, it will always be 100, right? I mean, let's say this stock, the fund value of this particular year zero, 100 become, let's say 400 in year 10. Yeah, then the return that we get here is how many percent? Is also 300%, right?
Yeah, it's 300%. This is for total years. Okay, how about we using another another way to looking this simple interest. Okay, let's say you invest in 100. Okay, you invest in 100 in the stock market,
Yeah.
and then next year you earn 100%. So 100 become 200%. 200, right?
Yeah, but we didn't sell it, right? So we cannot use the additional 100.
Yeah, But if the stock price from there rise another 100%,
to 400.
I'm not talking about the. Okay. Okay. Can you record down some figure, because you
yeah.
have many figure. I hope
Okay.
you record down. Otherwise
Yeah.
you can't keep. Otherwise you can't keep pace on that.
All right. Yeah, you may start.
Okay. Let assume.
Mm.
Let assume. Your initial capital is 1,000.
Okay.
Is 1,000, and then this is in the first column. Okay. You can use Excel to calculate. So this first column, I call it the. I can say this is the initial investment. Okay. Initial investment.
Yeah.
So the second could be the earning. So that means that the second column could be the earning. So that means this is the profit you earn from your investment. Okay. And the third column is net worth. Okay. So that means the total money you have.
Okay.
Okay. So if let's say, okay, the amount you earn, yeah, the earning is 10%. Okay, it's 10%. So it's something like you use 1,000 times 10%. You use 1,000 times 10%, so it's 100. So your net worth is the first column plus second column, right?
Yeah.
So now it's 1,100.
Yes.
Okay. Yeah. If you are using the Excel, okay. Okay. So now, if this is the simple interest rate, so the earning will always using the 1,000. Will always using the 1,000 times 10%.
Yeah.
So your earning is fixed. So that means this is a simple interest income. Yeah, the income is always fixed because this is simple interest.
Yeah.
So that means how much money you grow is using the base to calculate the interest.
Yeah.
So this is when the case, for example, you do the fixed deposit. And fixed deposit, you have two streams. The first is reinvest your interest. Yeah, and the second is the interest directly go to your bank, go to your saving account, saving account.
Yeah.
So for second type, of the fixed deposit, this is the simple interest.
Yeah. Yes.
Yeah. So what is the compound interest? The compound interest actually the next year, the year one, the initial investment is actually the net worth of year zero. So it's 1,100. Okay. Yeah. So that means and then the earning is no longer using the 1,000. Yeah. The year zero 1,000. Now if you calculate the earning for year one, is actually using the initial the first column, the initial investment of year one. So it's 1,100 times 10%.
Oh, you mean this is the year one. Just now is year zero.
Yes.
And then you mean the net worth for year one will be 1,100 plus 10%.
1,100. Yeah, correct. Yeah. 1,100 times 1.1.
1.1, and then so it's like add another 110 to
Yes.
1100.
Yeah.
So it's 1110. Okay, in this case,
1210.
yeah, right, sorry,
Mm.
1210. So in this
Yeah.
case is compound interest. I can understand, um, but why do we use 1100 for year one capital?
Yeah, because
Because we didn't sell this stock, right? So the money that helped us uh to earn money is still the initial capital in year zero, isn't it?
okay, assume the stock price now is 5. Okay, now it's 5 in year 0. Okay, in year 0, and then in year 1 grow 10%, so it's 5.5, right?
Okay, yeah,
Yeah, so
5.5.
if 5.5 rise another 10% is how much?
Oh,
Hmm.
okay, in
Yeah,
this way.
yeah, we're looking in this way. So actually, uh, yeah, why we looking at the compound interest? We're looking, this is not why we're looking at the compound interest. Is why we're looking at the percentage we can earn in future. Yeah, the additional
Mm.
percentage we can earn in future is because
Okay,
we
I
need
think
to
I
we need
suddenly get it.
yeah, because we need to compare. For
Mm,
example, now, for example, you have stock A and stock B,
yeah.
and stock A and stock B, their valuation is the same. Yeah, their valuation is exactly the same. And stock A,
Mm,
market capitalization already rise 1 times. Yeah,
yeah.
but stock B only rise 50%. Yeah,
Okay.
and you think their valuation is the same. Yeah, yeah. So that let's say stock B
Mm,
is half of the size of stock A. So
okay.
theoretically, stock B market capitalization would be half of stock A, right?
Yeah.
Mm. But stock A rise 100%, but stock B only rise 50%. And what will you do? And if you believe this is similar stock and they apply the same valuation method, so you will sell your stock A and buy the stock B, and perhaps in future stock B will rise another 50%. Or maybe stock A will drop 50%. Do you get
Mm,
what I mean? Yeah. So you are looking the further you are looking the additional percentage you can earn, because you can compare. You can compare in the market. If the stock price is overvalued or if it rise too great, you can switch to another stock. They can generate you uh more percentage of gain,
mm,
because stock won't rise forever. Yeah. For
yes.
example, from 10 to 20, this is 100%. And actually, from 10 to 20 is 100%. Yeah. Uh, but you want to get 100%. Another 100% is from
Mm,
20 to 40.
yeah.
Yeah. So if you're looking at the market cap now, is for example is 1 trillion to 2 trillion, 2 trillion to another 4 trillion, to another 2 trillion. So add up is 4 trillion.
Mm,
Yeah. So this when the market capitalization become significant and grow, yeah, the stock price performance, the percentage you can earn from the particular ticker will be lesser.
mm,
Mm. So many people, this is the reason why many people don't like to invest in high market cap stock. Yeah, because they think high market cap stock cannot rise further. So they prefer the low cap stock. Yeah,
mm,
low cap stock. Yeah.
yeah.
Mm. So is this clear now?
Um, yeah, I think to be fully understand, I need some time to digest.
Yeah.
Yeah, but I got some logic here from
Mm.
your explanation.
Mm.
Yeah.
Yeah. So is it all you want to share for today?
Um, yeah, because I actually don't have much thing to share
Mm.
today to
Yeah.
get
So
wealthy.
what is the summary? The summary is start to the financial advice you receive is start doing investment. Is it?
Yeah, start doing investment and also yeah, actually to increase my income level. But for this one, um yeah, I wasn't doing I wasn't working on this part.
Mm.
Yeah, you
Yeah.
also mentioned like we may go to uh like for example go to Singapore and then to earn uh maybe the same maybe um because of the currency difference, so we may get
Mm,
higher income, right?
mm.
Yep. This is also your advice.
Yeah. Yeah. For the investment part, which stock you invest, or I should say, maybe you invest in like the index. So I mean, which ticker you invest.
Okay. For now, I'm actually quite greedy because um I currently investing in uh quite a few stock, and I didn't focus on one or two. Okay,
Mm,
let me see. Yeah, in my portfolio I have Google
okay,
and then Microsoft
okay. Yeah,
and
Microsoft
then
is a good company. Yeah, recently I have some experience. And
uh
then yeah, what is the next?
and then 10 cent. Yeah, but now
Oh,
it's dropping. We have to
yeah,
wait. And there is a lot of uncertainty, right, for this.
yeah, yeah, because this is a Chinese stock, so
Mm,
so they will have some uncertainty. Yeah,
yeah,
uncertainty.
yeah. And then I also keep Xiaomi.
Oh, Xiaomi. Mm, yeah, and I I didn't check the stock price, but I know some news that Xiaomi is going to build a car,
Yeah,
right?
EV, right?
Mm.
Mm,
I don't really, how to say, I don't
have
really like,
confidence in them.
yeah, and have confidence on that. And because I'm not sure whether I'm not sure whether the stock price rise or drop after the news came out. Yeah, I really
Um,
not sure. I think
I
it's right, right.
Yeah, rice, but not a lot.
Mm. Yeah,
But
no.
I get into this stock at quite low price. I get into this at 21.
Oh,
So
so it's
now it's 26 already.
oh, okay. Mm.
Yeah, and then I also invest is the day before yesterday in DDD, uh the 3D company.
Oh,
Yeah,
mm.
because it dropped a lot and I managed to get 13% right now.
Oh, wow, not bad.
Yeah,
Mm.
but I think I'm greedy because I am looking for this kind of stock that go to the low value.
Mm.
Um, and then also what do I have? Porter and Gamble. This one I invest in 1 or 2 months ago.
Mm.
Yeah,
Yeah.
and then what else? I have Xin Solar. This is for the solar energy from
Mm.
a Chinese company.
Mm.
And then last one, I have one which is now losing money is the Rolls-Royce.
Rolls Royce? Why is this? What's the company doing?
The
Is it
company
the
is
car?
yeah the car, but actually
Oh,
they are also doing the engine for aircraft.
okay.
Hmm.
Mm.
Yeah,
I
I buy it
think
at the price 110. and now it drops to below 100.
Yeah. So I just checked the price is like 99, right?
Yeah, 99.
Mm. Yeah. In my opinion, this is not the how to say uh good company.
Mm,
Mm, maybe. Yeah.
yep. Yeah, so that's it. And then yeah, actually I am quite greedy and I think I can try to make money from some of the stock that are dropping a lot.
Mm.
And then after that, I can sell them and invest back to a few major stock, which I think in the future they can be uh, uh,
You can hold long term, right?
yeah, yeah.
Mm. Yeah. Uh, I cannot say this is wrong or right. Yeah.
Mm,
Many people are doing this. Yeah. For example, many people who buy the cryptocurrency, they also think that mm, they know Bitcoin and Ethereum uh is a quote unquote safest
mm,
and most promising investment
yeah,
uh in cryptocurrency.
yeah,
So but they will try to invest in other altcoin. And then
yeah.
after they
XRP.
gain, oh wow, there's there's totally a shitcoin. Yeah, yeah,
Mm,
yeah. Because of centralization. Yeah, yeah. So okay. Back to the topic.
mm,
They want to invest in other altcoin. For example, like the Dogecoin. Yeah,
mm,
Dogecoin. Mm. Okay. Yeah. But I think the Dogecoin is is better than XRP. Yeah, in my humble opinion.
oh.
Because at least this is decentralized. Hmm. Yeah.
Mm,
So they kind of invest in other altcoin and they expect a high returns relate relative to Bitcoin and Ethereum. So that after that they can convert their earning and their
mm,
principal back to Bitcoin and Ethereum.
yeah.
And actually we know like 90+% of the altcoin eventually will go to zero.
Mm,
Mm.
yeah. Yeah, and I believe that many of the investors they also don't intend to keep it for long, right? They wish
Mm.
to uh uh go out the market after
Yeah,
the stock price increase.
yeah, yeah. Many people say they are long-term investor, but uh but you can but you can only know who are the long-term investor after the stock price cut in half.
Mm,
Mm. And after the stock price cut in half, there are two type of person still in the market. The first is the real long-term investor. The second is they are short-term investor, but they are forced to become a long-term investor.
yeah, they are not willing to sell right at that time.
Yeah,
Yeah,
because yeah, they just lose
suffering
too
a
much
bit
money.
lost.
They just lose too much money. Yeah.
Mm, yeah.
Mm. So they convince themselves they are the long-term investor. It's
Mm,
quite funny.
yes.
Mm. Yeah. So okay, should I start my sharing?
Oh yeah, yeah. Go ahead.
Okay. Can you open the file that I shared to you? This
Okay, wait a
the
minute.
Excel file. Yeah, and this is the compound interest calculator. Yeah.
Okay, wait a minute. Okay, wait a minute. I couldn't. go to the chat box because
how about I send you in WhatsApp?
yeah, okay. Oh, okay, yeah. Right, never
Okay,
mind.
can already.
I know how to click it. Click it right now.
Okay.
Okay. All right. Yeah.
Yeah, there are 3 tabs, right? Three worksheets.
Yes.
You can ignore the budget and the plan.
Okay.
But I will tell you how this budget and plan tab work. You
Okay.
can feel you can feel your salary and your expenses.
Oh.
Yeah, and in the budget tab. Okay, and for the row 23 to 31. Yeah, of course you can insert row. And if you look
Yeah.
at the D23 to D31, they are something like
Yeah.
fixed and
Yeah.
variable. If you try to type some amount, for example, you try to let's say you select 23 to 30. You select B23 to 31, and then
Okay.
you type 5. You type 5, and then you type 5 and then don't enter, and then you press control key plus enter. Okay, so it's something like now it's B23 to B31, all is fine, right?
5 and then control key plus enter. Oh yeah.
Okay.
Wow.
Yeah.
I don't
Okay,
know
so
about this. Shortcut.
and then you go to C23, you use the B23. Let's say you times 3.
Okay. What do you mean? Do I need to insert the equal sign?
Yeah. You need to insert the formula.
Okay.
Okay, and then you drop down. Do you know how to drop down? Drop down the amount from 23 to 31. So
Wait a minute. I am times 3 first, right? Okay.
Yeah,
And
just
then
times 3.
drop down until C31. Yeah, so all of them is 15.
Yeah.
Yeah, okay.
And then
Done.
okay, and then you can okay, you can look at the fixed and okay, you look at the D33 and E33. See, there's a
Okay.
fixed and variable, right? And then D34 and E34, there's an amount, right?
Yeah.
So if you look at the D34, this is a sum A formula. So this is actually using the amount in C. Yeah, in D23 to 31, and then based on the D column, if you type fix, and then they will capture the amount. So that means now they were using like C24, C28, and C39, and then add up this amount. So it's 45 times 12.
I get
Yeah.
it.
So
Yeah.
if you use if you let's say if you click D let's say if you click D23, you copy and paste the fix. Yeah. So or you type the fix.
Okay.
Yeah. So the amount will
Thanks.
change.
Yeah.
Yeah. So that's this when you fill here, and then it will help you to split the fixed and variable. Yeah. And then and then okay, the blue highlight, the blue color highlight is something that you need to fill, and then otherwise you don't need to fill. It's something like that. Yeah. So this is other is the formula.
Okay.
And then okay, I think the below one you can ignore. Yeah. This is just yeah, but sorry, a user can refer to. Okay, let's say you look at the because this formula is not well set. I didn't make it like I didn't make it like the template because this is only one person use. Okay.
Oh.
Yeah, if you look at the C41,
C41 investment return rate.
C41.
Yeah, so it's 24985.
Yeah, correct. Yeah, so it's actually using the inflation rate. Inflation rate, you type in A40.
A40. Oh, okay.
Yeah, so it will actually calculate if you think the inflation rate for the foreseeable future is let's say like 5% or 2%, and then you just type the 1.02 or 1.05 in the A40.
Yeah, got it.
And then this will help you to calculate the inflation rate. So what is the amount C40? Actually, C40 should be blue color. Yeah, should be blue color. And then if you type like your fixed cost, yeah, your fixed cost will increase like 5% every year. Yeah, because fixed cost can calculate like this. Yeah, and because variable cost is variable, so it is not fixed. No, sorry. I mean, sorry. Let me rephrase. This you can type variable cost in C40. So that means if you follow my instruction, as I mentioned earlier, your variable will be 90. Your variable will be 900, right?
Variable 900. Okay, wait a minute.
E34. E34.
Yeah.
How much
Yes.
money? Yeah,
900.
900. So if you link the formula, C40, so you go to so you select C40, and then you type formula equal E34. So that means it's 900. Yeah.
Okay, equal E34. Enter. Oh, yeah, it's now 900.
Yeah. So and then the below figure will based on the 1.05 to calculate. Yeah, and then the fixed one. Why the fixed one is fixed? Let's assume the car installment will be fixed, the insurance will be fixed, the housing loan will be fixed, but maybe the property tax will be fixed. Yeah, maybe the network will also be fixed. Yeah. So other expenses will be variable. Yeah, because it will grow when the inflation rate increase.
Yeah.
Yeah. So when this is fixed, especially for those housing installment, insurance, yeah, because this is fixed, it won't increase. So inflation won't apply on that. And only variable cost, only the cost variable in nature will apply to the inflation. Yeah.
Yes.
So if you use this amount, okay, and then you just go to the plan tab.
Okay. What do you mean plan?
A plan worksheet.
Oh, okay. Yeah.
Okay. And then you look at the D8.
D8.
So now it's
900,
right? Yeah.
Yeah.
So you can type in D1. D1 you type 2% or you type 5%. Yeah. So it will help you auto calculate the variable cost grow based on the inflation rate.
Oh, yeah.
Yeah. But this formula is not well set. Yeah, because I put in some amount inside. If you see the D9 formula, there is something like minus 640. Yeah. So
D9.
yeah. So
yeah.
yeah, you can ignore that. So actually, this formula, if you really want to use, you need to set from the ground base. Yeah. Because only me can use, and I just delete all the confidential figure in this morning. Yeah. And then if you look at the i7 is actually my housing price. Okay, for this plan is actually what I'm looking for. I'm looking for how much money I need for retirement. Yeah, it's how much money I need for retirement. And for column hash, I can sell my house anytime. And then i7 is my housing price.
Currently.
The house purchase price. So I assume it will grow it will grow 4% every year. Yeah. So if let's say I type, I copy the I type like if I go to hash 14, I type 1x2 914.52, which is the amount shown in I14.
Yeah.
And then the below amount will change. Yeah. Yeah. Especially the closing capital.
Closing capital.
Okay. You try to
Oh,
type.
yeah. Yes.
Yeah. G14. Yeah. So that's mean start from that year. Start from the next year of that year, and your opening capital will increase. So you have more fund to do investment and also pay to the fixed expenses and variable expenses. Okay. And if you go to the B7, okay, and now, okay, you can see yeah, if let's say okay, and then yeah, because after you sell your house, you need to pay rental, right? So you need to go to D4. Let's say your rental is 1,000. Yeah. And the valuation will also change. Yeah. I'm not sure whether it will change or not. Yeah, because this formula is not well set. So never mind. This is something like this is something, the template that I want to use to calculate how much money I need for retirement.
Yeah.
Yeah. So okay, now you can ignore the budget and plan. You just go to the net worth. Okay, this tab is the formula is well set. Okay. And then okay, back to the topic. What is the best financial advice I received? It's actually same as you. Same as the financial advice I give you. Earn more money. Yeah, increase the income. Yeah, increase the income earning ability outside the market, outside the financial market. Yeah, and this concept is actually told by my favorite writer, Li Xiaolai. Hey, and but we all know, everyone also tell you, you need to earn more income, but only him can tell in a way that can convince me, that have the profound idea, yeah, he can tell something by using a profound explanation. Okay. To when you want to earn when you want to become wealthy, you need to do investment. So that, and when you do investment, and you need to leverage the compound interest. And they actually have three variables. Yeah. They actually have three variables. It's a start and also it's an end. So that means it's a D3 and D4.
Yeah.
Start, end, and then and also is the D1 interest rate. So this is the compound interest rate per annum. Yeah, you only need three variables. So let's assume you start your initial capital is 10K. Okay, is 10K. And how much money you want to grow to? If let's say it's 100K. Okay. Okay, let's say it's 100K. And then what is your compound interest? Let's say it's 15%. Okay.
Yeah.
Yeah. So how many years you need to grow from 10K to 100K? You need 17 years, right? You can see the column E, your goal has been achieved. Yeah, 107K. Yeah. Yeah. So you need to grow from 10K to 100K.
Yeah.
With 15% compound interest, you need 17 years. Okay. So how to reduce the years in order to achieve, yeah, how to reduce the time to achieve the same goal? You can increase your initial capital. Let's say you increase your initial capital from 10K to 20K. Okay.
Yeah.
Okay. And just now is 17 years. Now you just increase 10K. And you just need 12 years. You just need 12 years. Your goal will achieve. Yeah, you'll achieve your goal. So just top up additional 10K. You can save 5 years. Yeah.
Yeah.
You can save 5 years. 5 years. Just top up 10K. So if maybe you don't have 10K, but if you but you can change the amount. For example, 1,000 to 10K. Yeah, you start is 1,000, your end is 10K, and you just need to top up another 1,000, and then your goal will from 17 years. Your goal will be achieved from change from 17 years to 12 years. So you save 5 years. Yeah. So this is amazing. And then another is because you don't want to change your end, you want to change your goal. Yeah. You don't want to change your goal. So what can you do is increase your ability. Yeah. Change the interest rate. So from 15% to maybe 20%. Yeah. Or maybe to 30%. Yeah. But you can see, okay, if you tie back the amount 10K in the start, okay. And then 15%, you need 17 years. So if now it's 20%, yeah, also similar, from 17 years change to 13 years, right?
Yeah.
Yeah. But in investing, interest rate is something that we can't really control. Yeah, the compound interest rate is something that we can't really control because just I say in yesterday, investing is not the task that near to 100% certainty. 100% certain. It's based on some luck. So what can we do? You can increase your capital, but you say I don't have enough capital. Okay, I change we change back the D1, the interest rate, to 15%.
Yeah,
Okay.
15%.
Okay, now it's 15%. The
Mm.
start is 10K, the end is 100K. So
Yeah.
you need 17 years to achieve your goal. Okay, but now what we can do, we can top up money every month because I don't have additional initial capital to invest. Okay.
Mm.
Yeah. So what if you can invest additional 10K, additional 10K per annum. So that means D2, the amount in D2 will be 10K.
Yeah.
Yeah.
Wow.
Can you see? Yeah. Now you just need 6 years.
6 years.
Yeah. Now you just need 6 years.
Mm.
Yeah. But why you just need 6 years? Yeah, it's because you
Yeah,
look at
our
the
goal,
B.
right?
You
How much one?
you look at the B13. Yeah, because you invest a lot of money. Yeah. Or you look at the B14, you invest 17, you invest in 17K, 70K. Yeah. So, yeah. But this is a mindset that if you want to shorten your goal, you need to invest more money, and then your earning will also increase. Your goal will also be achieved earlier. Yeah. And if we change the end to 1 million, so you want to grow from 10K to 1 million. Okay. If you didn't top up, top up money every year,
Yeah.
so that means D2 is 0. How many years you need to achieve from 10K to 1 million, and then the rate is 15%. You need 33 years.
Yeah.
Yeah, you need 33 years. 33 years. But what if you invest additional 10K per year?
Okay, go to 19 years.
Yeah, from 33 years to 19 years. Yeah, how many years you save, right? So it's 14 years you have saved. Yeah, you have saved 14 years. Your goal can be achieved 14 years earlier. Yeah. So Mr. Li Xiaolai, he used this example to explain why you need to invest, why you need to earn more money. Yeah, because only you can earn more money, you can have more saving, and then when you have more saving, you can invest more. Yeah. So that means we don't need to change our start. Yeah, our initial capital is unimportant. Our end, it depends on you. Whether you want 1 million, 2 million, or 10 million. Yeah. And the rate, the interest rate, is something that we can't really control. So we don't do something. We don't focus on something that we can't control. This is also this is also the thing you say in yesterday, right? You say yesterday. So we focus something that we can control, which is the D2, the annual additional investment amount. Yeah. So this is the thing we can control, and then we just need to do this, and then you can shorten your goal. Your goal I mean you can achieve your goal in a shorter time. Yeah, from 43 years drop to 19 years. Yeah. Yeah. So this is the best financial advice I have to say.
Yeah. Okay. Okay. What is the use for the market value here, which is
Oh, yeah.
value at 50 and then cost value is 10.
Oh, yeah. Because this actually I use, I have delete some column. I leave this because this can be useful. And if you type your cost value,
Yeah.
okay, let's say now your investment fund is 10K, okay, and then the market value now is 1 million. It's 1 million. So how much you earn from the financial market is 99 times.
Yeah.
Yeah, 99 times. So yeah, this is a very simple calculation. Yeah, normally okay, yeah, because I did some column, and initially this cost value is linked to some cell which is how much I invest in cryptocurrency.
Oh.
And then now and then when I want to check how much money I earn from the investing, I just need to check the market value.
Oh, I
Yeah,
see.
how much market value for my investment. Yeah, so I type the market value so I can see, yeah, I have earned like maybe like 100%, 200%. Yeah, for this like 1 year or less than 1 year. Yeah, so this is just a simple calculation.
Oh, okay.
Okay, so
Yeah.
that's all for my today's sharing. Do you have anything to add in?
No.
Okay,
Yeah.
so that's all for our today conversation. How do you feel? Did you enjoy the conversations? Please tell us what you think of our conversation. And we are not native speakers. If you found any vocab or grammar mistakes that we make, please also comment to let us know because we want to learn more and improve ourselves. Remember to like and subscribe to us. Thanks for watching. See you tomorrow.
See you tomorrow.